Hey, good morning, everybody, and welcome to this Tuesday, September 20, what do we got, 23rd, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again this morning. Another really solid day in the market yesterday. Really kind of surprising. Well, not surprising when you think about how strong this bull market rally's been, but kind of surprising when you think about all the things that the market was up against. Yesterday was the Monday after monthly options expire. That historically has been the worst day in the market since 1950. The Mondays after options expire generally struggle to go higher. I think the success rate on going higher is only at about 37%. Versus 53% on any day since 1950. So pretty significant odds, stacked against the market moving higher yesterday, and still it went higher. I've talked about this week being the second worst week of the year historically. September, the worst month of the year historically. The second half of September, much worse than the first half. Actually, the first half is pretty decent. It's the second half of September that gives the month its bad name. So, we put all this stuff together, and of course, we expect that the market could struggle. And yet, market just seems to have its head down, keeps going up no matter what. And now we've got a couple more issues that I'm going to talk about this morning for the market in the sentiment area. Yesterday, I wrote to our members in our weekly market report, talked about the 5-day moving average of the equity only put call ratio, which had declined below 0.55. I'll show you how you can create that chart just a little bit and how you can track that. But essentially, when you get a 5-day moving average of 0.55 or less, it means that there's a lot more calls being traded in the market. So a lot of folks betting on the market to keep going higher. And usually when you start getting an imbalance of puts versus calls, especially over a 5-day period, many times that can at least calm the market down or cool the market down for a period of time. But again, I'll go over that with you in just a minute. But before we get into all these sentiment issues that we could be facing here over the next couple of weeks, let's first take a look at what happened in the market yesterday. You can see the Dow Jones Industrial Average. And by the way, just about everything green again. We saw small caps and mid caps struggling early in the session. Later in the session, small caps went positive. Mid caps didn't quite go positive, but they certainly made up a lot of their earlier losses. But across the rest of the indices, you see nothing but green. So the Dow Jones Industrial Average gaining 0.14%, S&P 500 0.44%. And then as you look at more and more growth, moving into the NASDAQ, 0.7%. So certainly money was rotating a little bit more into that growth area yesterday. And that's what you want to see as as somebody who believes we're in a long-term bull market. You want to see that money rotating back towards growth. And we normally don't see much of that this time of the year. Once we get past the summer months and we start moving into the fall, September, October, November, these are months generally that benefit more value-oriented areas of the market, at least relative to what we're used to during the summer months. So seeing money rotating back into growth, number one, maybe just a little bit surprising, maybe not, considering rates are coming down. But at the same time, historically, we do know that this is the time of the year where money starts to rotate a little bit away from growth, or at least not as heavily towards growth. Maybe that's a better way of putting it. Anyhow, you can see green across the board. That's the big takeaway. But the VIX was rising. VIX was up 4% yesterday, back above 16, even though the stock market was moving higher. Remember, the VIX not that long ago was down 13, 14 area. Now we're back up over 16. So we've been seeing some of that sentiment, those sentiment issues creeping up. That's very unusual for the VIX to be rising when the market keeps going up and putting in all-time highs each day. So it's just telling us that the market's still a little nervous When we have sentiment issues in the equity only put call area, it's more of a sentiment issue based on individual traders, retail traders that are growing a little bit too optimistic. One side of the trade is getting a little bit too heavy, and that can lead to a reversal. When you look at the VIX, this is another sentiment indicator, but the volatility index is based on how market makers price short-term options, specifically S&P options. So you've got market makers, which are starting to account for the possibility of more volatility, and that usually means selling. And then you've also got retail traders jumping on one side of the trade. So my point here is, and again, we'll look at some of the charts and take a look at what this could mean for the market, but I'm not changing my tune in terms of being very bullish the market for the fourth quarter, but the short term is definitely growing a little bit dicier, I would say. Again, does that guarantee us we're going to see this massive sell-off? No. In fact, we might not see any selling at all, but it is starting to raise some red flags. And so just understanding that, what I think you need to realize is that risks are elevated. They're starting to grow. Again, doesn't mean the market's going to sell off, doesn't mean it's going to sell off hard, that's for sure. But these warning signs, I think, are at least worth considering. And it comes down to how much risk you're willing to take. If you're younger and you've got 30, 40 years to retirement, probably, what I'm seeing right now isn't really, considering we're in the midst of a secular bull market run, I wouldn't be overly concerned. If, however, I'm in retirement and I'm on fixed income and I've got money in the market, I don't know. Depends on how much risk you want to take off the table. You could move out of some equities, move more to cash. I have not done that, but I'm thinking about doing it. And again, we'll talk a little bit about, the charts and what these charts look like and what's happened in the past when we've had charts look like this. But anyway, let's keep moving. Take a look at the S&P 500, which yesterday, again, seems like nothing's wrong when you look at price action, just going up and up and up every day, well above the 20-day moving average, which is above the 50-day moving average. You got the PPO now starting to accelerate again away from the center line. So that means we've got more and more bullish momentum. Bullish momentum is accelerating as opposed to decelerating when that PPO is falling. So now we've got that starting to accelerate. You got really nice volume. Of course, this was quad witching day. So if you go back, it's 4 times a year. So it's always the end of the third calendar month. So you're talking about March, June, September, and December. So here's September. If you go to June, there's June expiration. If you go to March, there's March expiration, and there's December expiration. So you're looking at 4 of the biggest volume days of the year, and that is typical when you have quad witching. That's when a lot of different options, futures, contracts, everything all expire simultaneously. And so you got a lot of folks looking to do something with their money. And as a result, you're going to see a lot more volume going through the market. So keep that in mind. So when you look at this, you say, wow, Tom, look at the volume trends. Volume was way up on, Friday when the market went up. I'd be careful using that thought process, because the volume's always heavy on the third Friday of the last calendar month of a quarter. So again, just kind of take that with a grain of salt. That really doesn't add anything to the price volume picture. But I mean, markets, we've been going up and the volume has been pretty steady on this move to the upside. I think volume trends are extremely bullish, but that doesn't mean we won't have a short-term pullback. And that's really what the question is now with, look at the RSI. RSI is now up to 74. When you look at some of the most recent highs, here, look at the RSI. It was up in the mid to upper 70s. Here, where we had a little bit of a pullback, we had hit 70. Here, where we were pulling back, actually, that was only to about 60. But you can see over here, trips to 70. But when you get into a more of a secular bull market type move, overbought can remain overbought for a longer period of time. And that's why, in my opinion, we are seeing the RSI move into the 70s and stay there for a period of time because we are in such a bullish move to the upside. But we are overbought, right? I don't think there's, everything I learned, RSI 70 is overbought. 75 to 80 starts to get really overbought. So if we start having really overbought conditions at the same time, we start having some sentiment issues and time of the year issues, you might want to just be a little more cautious. Again, it depends on who you are, how much, how cautious do you want to be? That's a personal choice. I try not to make that for everybody. I can't. I don't know your personal situation, but I can only tell you what's going on in the market. And there are some issues that are starting to build. I do want to emphasize these are short-term issues. These are not long-term issues. These are not, oh my gosh, here we go into a bear market kind of a situation. This is the market makers might pull the rug on us near term at some point. I don't know when. Could be today, could be tomorrow, could be next week. No guarantee it's going to happen. The risks are increasing. That's the key. And sometimes I'll get feedback, Tom, you're kind of waffling a little bit, saying the market's bullish, you're bullish the market, but then you're saying we can pull back. Well, that can happen anytime. I'm not really waffling, but the odds, the risks of a short-term pullback are starting to grow. Again, no guarantee that we're going to get it. So it comes down to each individual. How much do you want to pay attention to the risks that are building? Market pulls back 2 or 3%. There are going to be a lot of folks that move to cash. They're going to say, wow, well, thanks, great call. There are going to be others saying, well, you said the market was still bullish. I stayed in. I can only tell you long-term I'm bullish, short-term risks are increasing. That's where we stand. NASDAQ 100 also making a new high, new all-time high, pulling away from that 20-day. Also very, very, very overbought. RSI now 75.5. Small caps, we have seen a little bit of pullback. Not really. I mean, we broke out above the 241 level. We've stayed above the 241 level. We had a nice recovery yesterday, gaining about almost 0.6% after being down earlier. If we go to an intraday chart on the IWM, you can see we were down early while the overall market, if you pull up the QQQ and the spider, QQQ for the most part, was down just barely at the open, and that was it. Spider was down a little bit more, but it quickly came back. You can look at the IWM, you see that the selling was a little bit deeper, and we didn't break into positive territory until late in the morning. Did pull back, go negative one more time before we had a pretty strong afternoon. A lot of buying in the afternoon. So small caps, like I said, you can see we did have a little bit of selling, held on to the breakout level though, and then rallied throughout the rest of the day, trading and finishing up near the high of the day. Let's talk about the transports. Transports just can't seem to get going. I've talked about it. I don't really know what to say about the group. Normally, this is a group that does well, especially when the Fed cuts rates and talks about more rate cuts. That normally is a sign that we're going to get a strengthening economy, and a strengthening economy is exactly what drives transportation stocks. So I don't know what to make of this. If you know, hey, write in comments. I'd love to hear what your take is on this. Why are transportation stocks not going up? Just about every other rate sensitive area has really been strong in 2025. But you look at transports, we started the year at 16,000 and right now we're at 15.6. So year to date, we're down. Look at, let's take a look at the small caps. Small caps beginning of the year, 230 or a little under. Now we're at 244, up for the year. How about something like the XHB, which is an ETF that tracks the home builders? Back at the end of last year, 105, 106. We just got up to 120. We have pulled back now. And so the XHB, I think this is an interesting area, by the way, on the XHB. Personally, I did actually pick up a little bit of it just because I think, we had such a good run in the anticipation that we were going to get rate cuts. And then I think this has been a little bit more of a sell on the news. You can see we made a move up here with this long tail. Let me zero in here. We made a big move up. This was the day that the announcement was made. Home builders took a big push to the upside, but I think we had already reached the top. I think some of the buying was maybe a little exhausted. And as a result, we've seen nothing really but selling since that news, since that a very initial spike. We were up to almost 119. Now we've come back down about $8. From the top, we've now come down nearly 10%. So pretty nice little pullback in an area that should do well down the road with lower interest rates, lower mortgage rates, and so forth. Let's see, what else do we have? Let's take a look. Let me put together these charts here for you for a second. So if we take a look at the S&P 500, I want to look at these sentiment charts. Actually, we're about halfway through. Let's do this. Let's talk first about earnings beats. I'll come back to that in just a second. For those of you, though, that like what you see here on YouTube from us at Earnings Beats, take out a 30-day trial to our paid service. Go over to Earnings Beats. We do have a 30-day free trial. You can check us out. We do a lot of research. We provide great guidance to our members. We provide a lot of education. So you can check all that out, get a free 30-day trial. This obviously would be a great week to consider it, because we are going to be having a big event on Saturday where we will be talking about, well, you scroll down, you'll see it right here. 2 ways Wall Street is failing you. That is coming up on Saturday, September 27th. That will be at 10 a.m. this Saturday. It is a completely free event. If you click on this, it will take you to our landing page where you can sign up with your name, email address. That's all it takes. Hit that submit button. Make sure you register for this event. Save your spot. Seating will be limited, so you want to make sure you get registered early. But then check this out. I mean, I'm not going to go into all the details. I'll let you come in and read about this and look at some charts. But I think it is going to amaze you as to how much, what's the right word? How much Wall Street manipulates us. Manipulates is certainly a word that comes to mind right away. Maybe disappoints would be another word. If you think that they are trying to educate you on CNBC and other media outlets, I got breaking news for you. They're going to tell you after the fact. So again, this is going to be a big event. I think everybody should maybe reconsider how they look at Wall Street. A lot of folks will throw their hands up and say, well, we just don't understand the stock market, blah, blah, blah. Well, it's time to understand the stock market, if that's the way you feel, because we understand the stock market at Earnings Beats. Our members are beginning to understand the market. You got to see the charts. You got to follow what they're doing on the charts, not what they're saying on CNBC. And if ever, there's been a visual to point out exactly what we're talking about, it's going to be on Saturday morning. So make sure you register for this. I think it'll be a great event. So please come check that out. Also, if you continue to scroll down at Earnings Beats, you will see we have a free newsletter. Name, email address, hit that subscribe button. You'll be set up twice a week. You will get articles from us. And when I say articles, I mean, it's 2 paragraphs in a chart. It's very simple reading. Many times, start of this week, I was laying out some of the historical issues in the market, but many times it's a chart that you can trade if you so desire. The trade is completely up to you. We are not registered investment advisors. I'm not advising. I'm not recommending. I'm not licensed to do that. We are educating. So we point out things, and then it's completely up to you whether or not you want to trade. Consult your financial advisor. Think about things. Maybe sit down with your folks at your broker, whatever you do. But I do think that you can learn a lot from Earnings Beats. And let me give you one of our last charts that we gave to folks who are our Earnings Beats Digest subscribers. So make sure, by the way, you sign up for that. But let me show you a chart that we just gave out a little over a week ago. Applied Materials. Applied Materials right here on this breakout above the 20-day moving average. It was this next day, I believe, or no, actually, it was the day after the pullback. We had a slight pullback. And then Monday of last week, I talked about a bottoming head and shoulder pattern and how we were essentially in the right shoulder. And that if we could break out above 200, that would be a really bullish development for Applied Materials. And so let's take a look at the chart here. I want to go show you a weekly chart. But here was the top off of an uptrend. Here you come down to the left shoulder, neckline, head, right side of the neckline, right shoulder, almost exactly the same as the left shoulder. And now up we go with volume picking up. And it looks like we are right on that neckline. But this stock, for anybody who jumped in looking for a bottom, this was, I think, right around the upper 160s when we put this out, 6 trading days ago? Let's see, 1, 2, 3. Well, this is weeks. Let's go back to that daily chart. So right here, 1, 2, 3, 4, 5, 6 trading days ago. Stock was in the upper 160s. Now it's at 200. Look at the AD line breaking to all new highs. So there's a lot of what appears to be accumulation in Applied Materials. Now, all the news stories out there recently have been talking about the competition that they have in China. Applied Materials has not been a good relative performer, but it sure does seem like there's somebody accumulating the stock. And now we're getting that breakout. And by the way, this measurement from the neckline, which is up at about 200, down to the low, which is just a little bit below 125, that's over 75. That's like $77 measurement. So a breakout above 200 measures to $277, which would be an all-time high on Applied Materials. So that's just one chart that we provided, again, for free. These are the types of things we do. So again, go over to earningsbeats.com and make sure you sign up for our EB Digest. Completely free, no credit card required. Why wouldn't you? Tens of thousands of folks have joined us. There's no reason not to join. Anyhow, and by the way, if you like our videos and stuff, like the video. Please help us on YouTube. Like the video, subscribe to our channel, and then make sure your notifications are turned on. We'll reach out to you whenever we're doing any kind of a live show. So no reason not to do that as well. And you help us in the process. Even if you don't become a member, hey, I know subscriberships, newsletters, and that sort of thing is not for everybody. We do have a free one, so you can check us out and see if we fit, see if you like us, see if we help. But even if you don't want to go in that, go that route, you can help us by simply liking the video and subscribing to our channel. All right. So let's talk a little bit now about these sentiment issues. So the S&P 500 moving along great. Now, if we go down here to the bottom, what we can do is we can pull up price on here. Right there. And we can change this to CPCE, which is the equity only put call ratio. And I'm going to make the panel a little bit bigger, same size as the price chart. And so here you go. Now this is showing every day's ratio, right? Now what it doesn't show you though is what the 5-day moving average is, which is what I like to follow, because you can see, look at the individual daily readings. They're all over the place. So 5-day moving average kind of smooths things out. You could use 10-day, you can use whatever. But let me show you how you can do this, how you can set it up. So here, the style of the panel right now is just set to auto, but we can go down here and change it to invisible. Now, when you change it to invisible and you update the chart, it goes away. There's nothing there. The price action's gone. But what I want is a 5-day moving average. So I can do an overlay, simple moving average, 5 days. Now I update it and voila, here is your 5-day moving average. Now, when you look at this, let me annotate. Now, over time, I've kind of said whenever you get down to 0.55, that's when the market is starting to get a little bit too complacent, too many folks are getting into calls, thinking that the market can't do anything but go up. That's usually a recipe for the market to go down. Anytime all retail traders start moving to one side of the trade, that's when you bottom. Look here. Look at this is when we spiked and we got to the highest level of puts versus calls on a 5-day moving average. So all of a sudden, retail traders are getting overly cautious, overly bearish. That helps to mark bottoms. Marking tops, though, is where the sentiment comes in when that 5-day moving average drops down to 0.55 or below. Now, in a continuing secular bull market, I can tell you from experience that these topping signals are not nearly as reliable as bottoming signals during a panicked market. So keep that in mind. It doesn't mean that it's not useful information. It's just that it doesn't always work. And so let's keep that in mind. It's not like I'm going to see this and go running for the exits and sell everything and start shorting the market because I know this signal doesn't work all the time. But I think it's still a useful signal to tell us it's just one signal. It's one secondary signal that's saying, hey, there's a lot of folks out there buying calls right now. You might want to be careful. That's all it's saying. All right. Now, let's see how far it goes down, because you can see a couple of things. Number one, when we've gotten down below 0.50, down close to 0.47, here we did it, and that led to a quick little 4-day retreat back to the 20-day moving average. Over here, when we did it in January, it was part of a lot of other signals. Remember when I said at the end of January that I was moving to cash? I didn't trust the market. Well, one of the signals was everybody in the market was so bullish. That wasn't the only signal. That was just one of many. If you recall, a lot of money was rotating into defensive areas of the market, which was starting to portend what was coming, which was this, which is why I moved into cash. We don't have that right now. Money is not rotating into defense. It's the exact opposite. Money is rotating into offense. So Wall Street is not prepping for a big drop, so we should not be prepping for a big drop. But if retail traders keep jumping into calls and this number keeps moving down, it could be a situation like we saw back in May, where maybe we get a little bit of weakness that gets maybe a 20-day test. Folks, 20-day test, we're only talking about 2% drop. I mean, after what we've done off of the April low, where we've gone up now, well over 30, probably getting closer to 35, 40%. I mean, that tells me that a 2% drop is nothing. It's, drop in the bucket, right? So understand that there's a lot more folks out there getting very, very bullish in the options world. Okay. Now let's do another chart where I'm going to pull up the VIX and just go back to the auto. Don't need any of that. So here you can see the S&P 500 on top, then you have the VIX down here, and I'm going to add one more indicator, which is the correlation coefficient. Right there. We'll add height there. And so the correlation right now is comparing the S&P to the S&P, which is why we're sitting up at 1. We don't really want that. What we want is the correlation of the S&P to the VIX over a 20-day period. And now we update the chart and look at what's happening. So let me explain first what normally happens in the stock market. The S&P 500 goes up, the volatility index goes down. When the S&P 500 goes down, the volatility index goes up. So what I'm going to do is I'm going to switch this to a 25-year chart. And I want you just to see that the correlation generally is down at -1. So we normally are all the way down at -1. Sometimes we have these spikes where we'll go through a period where the market, let's say the stock market is going up, but instead of the VIX going down, the VIX is going up simultaneously. So the market, the stock market, the market makers are actually starting to price options higher, as if there's a lot of volatile action, but the market's going up. There really isn't any volatile action. It's very complacent, like the options world just showed us. So this move back above zero, first of all, you can see we've never gone to +1. The most we've ever done is gone to about 3/4, 0.75 positive. But it's pretty rare just to go above zero. I mean, I don't know how many there are over the last 25 years, but my guess is probably not many more than 25. I mean, if 25. So on average, it probably happens once a year. It's not a very frequent occurrence. But if we go back and we look at this, say, over the last 5 years, I just want to point out that when we do make these moves, like, let's see, right here, this was May of 2021. At the beginning of May, we saw the market still going up right here, but volatility, the VIX was picking up, starting to turn higher. And that led to a little short-term sell-off. If you go into November of 2021, as we were going up, look at the VIX going up. This was a pretty high reading. We got up to 0.5. What happened after that? Market sold off. Let's see here at the beginning of 2023, the S&P was going down. The VIX was going down. So the correlation turned positive. What did the market do? The market reversed. So here, the market was going down, but fear was coming out of the market. Options were being priced lower by market makers. Why would they do that when the market's going down? Normally, when the market's going down, options get way more expensive. In this case, they were getting less expensive. Market makers were basically giving us a signal. Prices were going to go up. And there they went. Market turned higher. Now, these signals don't work every time. Look back at the beginning of 2024. I mean, there was hardly any selling at all. And we had multiple readings up above zero. How about July of 2024? Remember this little correction that we had? Look at the signal we had middle of the month. We had this go positive while the market was going up, and it started a correction. Later, this would have been in October of 2024. We ended up second half of October going down before we ended up moving higher again. So again, these aren't long-term signals, but this has a pretty decent track record of signaling to us that we might be getting close to a near-term top where we could see some selling. Because what's happening right now is prices are going up and market makers are essentially pricing options a little bit higher, as they normally would when the market's going lower. Why would market makers price options higher right now? Well, if the market starts to turn lower, it's making options more costly. So not only are retail traders right now moving into calls, but they're doing so by paying a little bit higher premium, which is kind of interesting. Market makers, it's almost like they're setting us up, if you think about it. It's like, okay, prices are going up. More and more folks are moving into options. So market makers are making those options more expensive to lose potentially more money if this market were to reverse. Now, again, I'm looking at something that maybe we get a move back down to the 20-day. And I've talked about this throughout September, so it's not like this is anything new. This is just one more signal, one more thing that we've got to try to figure out how we can get through from a bullish perspective. Will we get through it? I don't know. If we keep going up and more options are going to get played and the VIX keeps going up, we're going to see this line moving up and we're going to see that the options. Let's go back to that options. There we go. And if we keep going up and more options or more call options versus put options are being traded, you're going to see this going down. So we'll get closer to these extreme lows, while at the same time, if the VIX keeps rising during the move to the upside, we'll see that correlation move further and further into positive territory. So the longer this goes on, the more the risk is actually picking up. That's all I want to kind of point out. Anyhow, that is it for me. I'm going to talk about this more in the daily market report today. So again, if you become a member, you'll get a little bit more information on that. I'll go back and show some examples of what we've seen in the past and so forth. But yeah, I mean, I'm bullish. Listen, rates are coming down. That's great for the market, but a lot of it's priced in. We are still going through the second half of September. We're now starting to see some sentiment issues starting to build. So we are getting a little bit more in terms of some secondary signals that could result in the market pulling back here. So again, from a trading perspective, I might start to be, consider getting a little bit more cautious. If the market goes up, it goes up, great. Ultimately that's going to be good for anybody who's bullish and on the long side. In the short term, however, we could see a pullback. And if we do, just be really careful. This is a short-term kind of an issue. So from a long-term buy and hold, somebody thinking about retirement, what to do, I would stick with the market, because if you do get out, the market keeps going up, what do? It really puts you in a rough place. I'm not seeing signals personally that suggest to me we're having any kind of a 10, 20% sell-off. So I'm not worried about that. But as a short-term trader, I wouldn't be surprised if that proverbial carpet gets pulled out from under our feet, maybe in the near term, maybe within the next week or so. Anyhow, that's all I got for today. Have a great rest of your day, everybody, and be looking for that daily market report. And don't forget, Saturday, I just want to remind you one more time, 2 ways Wall Street's failing you. Make sure you click on that. Go to this page, sign up with your name, email address. Have a great day, everybody. Happy trading.